Hello students, my name is Vaishali, an assistant professor in School of Finance and Commerce, Galgotias University. I welcome you all to this lecture series on business organization, the course code for which is BCOM1001. The name of the topic is Forms of Business Organization. So let's get started with our presentation. So let's look at the contents of the presentation. It begins with introduction. Next, the different forms of business organization are listed. That is sole proprietorship, partnership and joint stock company. Next, we will cover the features, merits and demerits of sole proprietorship. Further, we will cover the features, merits and demerits of partnership, and after that we will cover the features, merits and demerits of joint stock company form of organization. And then at the end we will look at the factors which are looked at while deciding the choice of form of business organization. Students, if one is planning to start a business or is interested in expanding an existing business, a very important decision relates to the choice of the form of organization. Because the choice of organization will affect a multitude of factors, many of which will decide the company's future. The most appropriate form is selected by looking at the advantages and disadvantages of each type of organization and comparing it against one's requirements. This is a very big decision as it has long-term implications. So basically there are three forms of business which are very famous and often opted for while starting a business or expanding an existing business. Those three are sole proprietorship form of business, second is partnership, and third one company form of business. Now let's look at each of these forms of business organization one by one, looking at their features, merits and demerits. The first form of business that we are discussing is sole proprietorship. Now sole proprietorship refers to a form of business organization which is owned, managed and controlled by an individual, and that individual is the recipient of all profits and undertakes all the risk. The meaning of the term sole proprietorship is very evident from its name, because sole means only and proprietor means owner. Hence, a sole proprietor is the one who is the only owner of a business. This form of business is most suitable for small businesses, especially in the initial years of operation. You would have seen that a vast majority of small businesses start out as sole proprietorships. This form of business is particularly common in areas of personalized services such as beauty parlors, hair salons, and small scale activities like running a retail shop in a locality. It is very easy to start and close a sole proprietorship as hardly any legal formalities are required. Now, second is sole proprietors have unlimited liability. This means that the owner is personally responsible for the payment of debts in case the assets of the business are not sufficient to meet the requirements. Third is that sole proprietor is the sole risk bearer and profit recipient. That means that the risk of failure of business is borne by the sole proprietor himself. However, if the business is successful, then also the businessman will enjoy all the benefits. He will receive all the profits, which becomes a direct reward for his risk taking. Third is that sole proprietor has full control over his entity and he can make decisions quickly as he does not have to consult anyone. Sole proprietorship does not have a separate legal entity. That means in the eyes of the law, there is no distinction between the sole trader and his business, as business does not have an identity separate from the owner. Therefore, the owner is held responsible for all the activities of the business. Now let's look at some of the advantages of sole proprietorship form of business. First is quick decision making. Now, since a sole proprietorship is the only one who is managing the business, he enjoys considerable degree of freedom in making business decisions. Also, the decision making is very prompt because there is no need to consult anyone else. Second advantage is confidentiality of information. Since sole trader himself takes all the decisions and is also not bound by the law to publish any of the firm's accounts, he enjoys confidentiality of information. Third is direct incentive. Since the need to share profits does not arise as he is the single owner, so sole trader receives all the benefits directly. This provides maximum incentive to the sole trader to work hard. Last but not the least, ease of formation and closure. A very important merit of sole proprietorship is the possibility of entering into the business with minimum legal formalities, as there is no separate law that governs sole proprietorship. Sole proprietorship is the least regulated form of business. It is very easy to start and close the business as per the wish of the owner. Next limitation is limited life of a business concern. Now, the sole proprietorship business, as we know, is owned and controlled by one single person. So events like death, insanity, imprisonment, physical ailment, or even bankruptcy of that proprietor will affect the business and can lead to its closure. And that's how it will have a limited life. Next limitation is unlimited liability. In sole proprietorship form of business, a major disadvantage is that the owner has unlimited liability. So suppose if the business fails, the creditors can recover their dues not merely from the business assets but also from the personal assets of the proprietor. Next limitation is limited managerial ability. Now, as we have seen that in sole proprietorship, the owner has to assume the responsibility of various managerial tasks such as purchasing, selling, financing, etc. all by himself. It is very difficult for an individual to excel in all these areas. Thus, decision making may not be balanced in all the cases. Also, due to limited resources, sole proprietor may not be able to employ and retain very talented and ambitious employees in the organization. That is sole proprietorship. So we all saw that there was an inherent disadvantage of the sole proprietorship form of business in financing and managing an expanded business. Here, partnership serves as an answer to the needs of greater capital investment and more diverse managerial skills, and also sharing of risk. So if we define partnership, it's an agreement between two or more persons who will share their profits and losses on some predetermined basis. So let's discuss the features of partnership. First is formation. The partnership form of business organization is governed by the Indian Partnership Act 1932. So partnership comes into existence when a legal agreement is entered into by the partners. That agreement governs the relationship among the partners, sharing of profit and losses, and the manner in which business will be conducted. Second is liability. So the partnership firm has unlimited liability. That means personal assets of the partners may be used for repaying the debts in case the business assets are insufficient. Third is risk bearing. So the partners bear the risk involved in running a business. The rewards which come in the form of profits are also shared by the partners in the agreed ratio. Fourth is decision making and control. So partners can mutually take any decision and control the firm together with mutual consent. Next feature is continuity. A partnership firm is not considered to be a continuous form of business since death, insanity, or bankruptcy of any partner will dissolve the partnership firm and the remaining partners will have to enter into a new agreement, and that will give rise to a new partnership agreement. Last is maximum number of partners. So it needs 2 members to start a partnership firm. The Indian Partnership Act 1932 does not have any limit on the maximum partners that can be included. But according to Companies Act, a maximum of only 50 persons are allowed to form a partnership. The next form of business organization is a joint stock company. A company is an association of persons which is formed to carry out a business activity and has a legal status which is independent of its members. The company form of organization in India is governed by Companies Act 2013. As per this act, a company means company which is incorporated under this act or any other previous act under company law. So the features of a company are, first, it's an artificial person, which means that a company is a creation of law. Now, just like a natural person, a company can own property, borrow money, and even enter into contracts. But like a natural person, it cannot breathe, eat, run, walk. So therefore, it's called an artificial person. Next, a company has a separate legal entity. That means from the day of its incorporation, a company acquires an identity that is distinct from its members. Next, formation. The formation of a company is a very time consuming as well as expensive and complicated process. It requires preparation of a lot of documents. Next, perpetual succession. So unlike partnership or sole proprietorship, the existence of a company does not depend on its members. Members may come and go, but a company will go on forever. Last one is common seal. Now, since being an artificial person, a company cannot sign documents. That's why a company has a common seal. Let's look at some of the advantages of the company form of ownership. First is limited liability. Now, in a company, the shareholders are liable to the extent of the amount unpaid on the shares held by them. Also, only the assets of the company can be used to settle the debts, and owner's personal property is free from any charge. This will reduce the degree of risk which is borne by the investor. Second biggest advantage is scope of expansion. Now, as compared to sole proprietorship and partnership form of organization, a company has larger financial resources. Further, capital can be attracted from the public as well as through loans from banks and financial institutions. Thus, there is a greater scope for expansion. Next is professional management. Since a company can afford to pay higher salaries to specialists and professionals, it can therefore employ people who are experts in their areas of specialization. That's why there are different divisions, and every division is supervised by an expert. This leads to balanced decision making and greater professional management. Now let's further look at the disadvantages of company form of organization. First is complexity in formation. As we have seen that the formation of a company requires greater time, effort, as well as extensive knowledge of legal requirements and the procedures involved. So as compared to sole proprietorship and partnership, formation of a company is definitely more complex. Second limitation is lack of secrecy. So the Company Act requires that each public company needs to provide from time to time a lot of information to the office of the registrar of the companies. So this way the information is available to the general public. So it is very difficult to maintain complete secrecy about the operations of a company. And also from time to time information is also provided to SEBI, registrar and other regulatory bodies. This reduces the freedom of operations of a company and takes away a lot of time, effort and money. Next limitation is delay in decision making. Now companies are democratically managed through the board of directors, which is followed by the top management, middle management and lower level management. So communication as well as approval of various proposals may cause delay in taking actions as well as acting upon them. Next limitation is numerous regulations. So a company has to fulfill many legal rules and regulations, including audit, filing of reports, preparation of documents, as well as obtaining various certificates. Next limitation is conflict of interest. So there may be a conflict of interest among various stakeholders of a company. For example, the consumers may want a better quality product, whereas the shareholders may want an increase in dividend, thereby increasing their cash flow, whereas the government may want the company to pay higher taxes. So this way a company has to fulfill a lot of interest of different stakeholders.